Hi, everyone, and welcome to our Managerial Accounting class. In this session, we're going to continue our midterm review by really digging into some of the trickiest problems you're likely to see. These are the kinds of questions that can really make a difference in your final grade. So we're going to walk through 3 specific types of problems that honestly trip a lot of students up. And trust me, if you can really nail down the logic behind these 3, you are going to walk into that exam feeling so much more confident. So let's get right to it. First up, we have the high-low method. Now, I know the basic formula seems pretty straightforward, but there is a super common trap that involves average costs, and you absolutely need to know how to spot it and navigate around it. Okay, so here's the problem. We're given average costs at 2 different activity levels, right? And we're asked to predict the total cost for a completely different level. Now, your first instinct, your gut reaction, might be to just grab those averages and plug them into the high-low formula. But if you do that, you will fall right into the trap. So this is the most important thing to remember. The high-low method is all about the change in total cost, not the change in average cost. So your very first step before you even think about the formula has to be converting those averages into totals. It's not optional. Let's walk through this the right way, step by step. First, we calculate our total costs. For our high point, that's 13,000 hours times $1.20, which gives us $15,600. For the low point, it's 8,000 hours times $1.50, which is $12,000. See, now we have the right numbers to actually work with. So in step 2, we find the variable cost. We take the change in cost, that's $3,600, and divide it by the change in hours, 5,000. And that gives us our variable cost of 72 cents per hour. From there, it's pretty smooth sailing. We can solve for our fixed costs in step 3, and then finally we can make our prediction for 10,000 hours in step 4. And there it is, the correct answer, $13,440. See how different that is? If you had tried to use the averages directly, you would have gotten a completely wrong answer. This is why you always convert to totals first, every single time. All right, let's move on to our second big challenge. We're going to crack the code on the cost of goods manufactured and cost of goods sold. You'll hear them called COGM and COGS. The secret here, really, it isn't about memorizing a bunch of formulas. It's about being able to picture the flow of costs, kind of like ingredients moving through a kitchen on their way to becoming a finished meal. Just think about it physically, right? Costs start out as raw materials sitting in a storage room. Then they move on to the factory floor where they become work in process, or WIP. Once all the work is done and they're completed, they move into the finished goods warehouse, ready to be sold. All these accounting schedules we're learning, they're just putting dollar signs on that very physical journey. So here's a pretty typical problem from a company called Tucker Manufacturing. They give you a list of costs, and your job is to figure out how to classify them correctly. And the one that usually throws people for a loop is that building depreciation. Where does it actually go? And here's the key idea. We have to split that depreciation cost. Only the costs that are related to production, the factory itself, are what we call product costs. Those are the costs that become part of our inventory. So 70% of that depreciation, $210,000, is a product cost. The other 30%, maybe for the sales office or administrative building, that's a period cost. That gets expensed immediately, and it never even touches our cost of goods manufactured schedule, which brings us right to the definition of COGM itself. It's so important to get this right. It's not the cost of everything you started working on this month. It's the total cost of everything you actually finished and moved from that factory floor over to the warehouse. It is the cost of your output. And if you think about it, the formula reflects that exact logic. You start with what was already in the cooking pot, your beginning work in process. You add all the new ingredients you threw in during the period. That's your total manufacturing costs. Then you subtract whatever is still left simmering in that pot at the end of the day. And what are you left with? The cost of the meal that came out of the kitchen, your cost of goods manufactured. Okay, for our third and final problem type, let's look at the margin of safety. Now, the really tricky version of this question doesn't ask you to calculate it directly. Instead, it gives you the answer and asks you to work backward to find a missing piece of the puzzle. It's all about reverse engineering. So here's the puzzle from Flaherty Company. We already know our cushion, our margin of safety, is $24,000. We know our total sales and our variable expenses. The big question is, what are the fixed expenses? So how in the world do we solve this thing? Well, we have to work backward.
Step 1 is to find our break-even point in sales. Well, if our actual sales are $120,000 and our safety cushion above break-even is $24,000, that means our break-even point must be $96,000. Makes sense, right? Step 2, we need to calculate our contribution margin ratio, or CM ratio, which comes out to 33.3%. Now for the real aha moment in step 3. Remember the definition of break-even? It's the point where your total contribution margin exactly equals your fixed costs. So all we have to do is multiply our break-even sales by our CM ratio, and that will give us our fixed costs.
And just like that, we have our answer. The fixed expenses have to be $32,000. Being able to work a problem like this backward proves you really truly understand the relationship between sales, costs, and that break-even point. Okay, we have covered a lot of ground pretty quickly, so let's wrap this up with a simple little game plan you can take with you right into the midterm. For the high-low method, what's the number one rule? Convert averages to totals, period. For COGM and COGS, don't just memorize formulas. Picture that flow of costs from the factory to the warehouse. And for margin of safety, if they ask you to work backward, your very first move is always to find the break-even sales. If you can just remember these key ideas and watch out for these common traps, you are going to be so well prepared for this exam. You've got this. Good luck on the midterm exam. I hope you all do well.